Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and a warm welcome to Wednesday's Money Talk. This is Peter Lewis. Thank you for making this podcast one of the 10 most listened to financial podcasts on Apple Podcasts in Hong Kong. I appreciate you taking the time to listen. This program is also on Google Podcasts and on Spotify as well. And this podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the pace of inflation in the US eased to its lowest level in more than 2 years in May, driven by a decline in energy prices. Headline consumer price inflation slowed to 4% year-on-year, down from 4.9% in April, marking its lowest level since March 2021. China's central bank lowered a key short-term policy rate Tuesday as it deals with disappointing economic data in the country. In a surprise move, the PBOC cut its 7-day reverse repurchase rate by 10 basis points from 2% to 1.9%, injecting 2 billion Chinese yuan, that's about $280 million of short-term liquidity into the interbank market. That's the central bank's first such move since August 2022. Loan data from China largely missed expectations and reinforced the recent indications of a sluggish recovery in the world's second largest economy. China's banks provided 1.36 trillion yuan in new yuan loans in May, increasing from 0.72 trillion yuan in the previous month, but falling short of market expectations. China's total social financing, which is a broad measure of credit and liquidity in the economy, rose to 1.56 trillion yuan in May, up from 1.22 trillion in the previous month, but also below market expectations of 2 trillion yuan. Hong Kong will ease entry rules for foreign workers to stem a manpower shortage in the financial hub. Chief Executive John Lee warned Tuesday of a risk to the city's economy and competitiveness, saying when we have a serious labour crunch, if we do nothing about that, the entire community will be affected. The CE said the scheme is not meant to be long-term and will stick to the principle of protecting the job security of local workers. On today's programme, I'm joined by Enzio von Pfeil, founder of Financial Shield, and Kuijs, Chief Asia Economist at S&P Global Ratings. And with a view from Japan is Nick Smith, Chief Japan Strategist at CLSA.
Peter Lewis's Money Talk.
US stocks rallied on Tuesday after the pace of US inflation eased to its lowest level in more than 2 years, bolstering investors' expectations that the Fed won't raise interest rates tonight. The S&P 500 rose 0.7% to 4,369, pushing higher into the bull market territory it entered last week. The tech-heavy Nasdaq Composite added 0.8% to close at 13,573. Both the S&P 500 and the Nasdaq are at their highest levels in 14 months. The Dow traded 146 points higher, or 0.4%, to close at 34,212. Nvidia closed with a $1 trillion valuation for the first time ever. Shares in the chip maker, regarded by Wall Street as one of the big beneficiaries from the surge in developments around artificial intelligence, closed 3.9% higher on Tuesday. And Tesla rose 3.6%. That's its 13th straight day higher and a new record win streak. The stock's up 41% in that time. The yield on the 2-year Treasury note, which is more sensitive to monetary policy expectations, rose 8 basis points to 4.67%. That's the highest level since March. And in the UK, 2-year gilt yields rose to their highest level since 2008 on Tuesday, after strong UK wage data heightened investors' concerns over stubborn inflation. UK wage growth accelerated by 7.6% in the 3 months to April. 2-year gilt yields rose 26 basis points to 4.89%. That compares with their peak of 4.64% in the aftermath of the unfunded tax cuts announced in the mini-budget in last September when Liz Truss was Prime Minister. Brent crude oil settled 3.4% higher at $74.29 a barrel, recovering most of Monday's losses. Asian equities mainly rose on Tuesday. Japan's Nikkei 225 added 1.8%, rising above the key psychological mark of 33,000 for the first time since July 1990. Hong Kong's Hang Seng Index rebounded from opening losses after the mainland's short-term rate cut to end the day up 117 points or 0.6% at a 3-week high of 19,521. This morning, the Hang Seng is projected to open 50 points lower. The Shanghai Composite was up 0.2% at 3,234. And finally, the onshore Chinese yuan weakened 0.33% to 7.166 renminbi against the US dollar shortly after the PBOC move Tuesday, and it's now at its weakest level since November, 6 months ago. The renminbi has declined 4% against the dollar this year, amid expectations of growing rate divergence with the US. If you want to get in touch, please go to my webpage, peterlewismoneytalk.substack.com, and while you're there, please have a look at my daily newsletter, which accompanies this show and has a lot more business and finance information from around Asia.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us our regular Wednesday morning commentator, Enzio von Pfeil, who is also the founder of Financial Shield and a capital preservation specialist for individuals. Morning, Enzio.
Good morning, Peter.
And also with us, Kuijs, who is Chief Asia Economist at S&P Global Ratings. Nice to see you again, Louis.
Morning, Peter and Enzio.
China's central bank lowered a key short-term policy rate Tuesday. In a surprise move, the PBOC cut its 7-day repurchase rate by 10 basis points from 2% to 1.9%. That puts about 2 billion Chinese yuan of short-term liquidity into the interbank market. The 7-day reverse repo rate sets the cost of 7-day lending from the central bank, and it's used to manage short-term liquidity. It's the first time the PBOC has done this since August 2022. But Enzio and Louis, why? Because there's already a lot of liquidity, isn't there, in the interbank system, and you can get it quite cheaply. You can get it about 1.8% at the moment. So why is the PBOC doing this?
Well, happy to go first. Unfortunately for the PBOC, it wasn't really their decision. They're not really in charge of this. They were told to do it. The Chinese recovery is ongoing, but after a rebound in the start of the year, it is not super fast at the moment. Definitely not in manufacturing and in the investment sphere. Also, confidence is quite subdued. So policymakers were under pressure to do something, even though they don't want to do a lot. And I would say, look at the size of this cut rather than the fact that there was a cut. I wouldn't expect a lot of policy easing in the coming months.
Are they trying to send a signal then if they were told to do it? Is it basically saying, look, here we are, we're ready to lend, ready to support the economy, sort of back up the government if necessary?
I mean, I think I don't know the details of it, but I wouldn't be surprised if even the size of it is not set by them, but that they, of course, will argue in a case for certain things, but that it's unfortunately it's not under the control of the PBOC. But I do think the weak inflation data helped strengthen the case a bit for this. But again, I wouldn't see this as the start of a very significant easing campaign.
Enzio, what do you think? Do you find this all rather odd?
I find it pointless because I think that as long as China keeps going this very Marxist route, it will kill common prosperity. After all, the private sector accounts for 80% of urban employment, 60% of GDP, and China really risks becoming a Japan 2, the one that we've all seen for the past 30-plus years of low rates, immense amounts of liquidity, and the market going precisely nowhere. And indeed, that's what the markets are telling us at present. The emerging markets Asia index returned just 1.3%. That's the MSCI's, whilst the MSCI emerging markets Asia ex-China returned 8.6%. The hedge funds are pulling out. They've pulled out by 31% since the end of May, and the debt pullout is about 31 billion worth of dollars out of China, and so Asia ex-China, I have to get used to this now, used to be ex-Japan for me, is going to become a bit of a star, but China is just languishing because of the policy direction taken. They can eat as much as they want. It's not going to get the dead horse live again.
Asia ex-China is going to be a significant change, isn't it, to the way in which you regard investing in Asia, particularly if funds and clients are now calling for more product that is Asia ex-China. It's really like we had 30 years ago, wasn't it, when we first started to see Asia ex-Japan?
Yes, and that's what's causing the rewiring in my brain, that one has to say now Asia ex-China, and I'm afraid that's going to last for a long time until they decide to get common prosperity really as their chief policy goal, which really can only happen through the private sector, creating that huge employment, and also treating the foreign multinationals better.
Do you agree with Louis that this isn't the beginning of an easing cycle? Because some people are taking this as, now we're on the beginning of more rate cuts, that we're going to see an MLF rate cut on Thursday. We're going to see a RRR cut as well, a cut to the medium-term lending facility.
Just for disclosure, I do think there'll be an MLF cut, but it will be 5 or 10 basis points, and it will basically just a follow-up of this. But I mean, like after this rate cut, I don't expect a huge amount of additional steps.
Okay. Enzio, do you think that's right? Do you think we're not going to see an awful amount of easing after this? Maybe a cut to the MLF?
I respectfully differ with Louis. I just think that they will keep cutting in the futile attempt to get the economy going, exactly what happened in Japan, which then went nowhere in a hurry.
So we've got important data coming out tomorrow, haven't we, Louis? We've got retail sales, industrial production, fixed assets investment. If one of the big engines of growth for the retail sales, if the numbers don't deliver what people are expecting, and we've also seen earlier on, we've seen exports slow as well. What are the pillars of the economy? What's going to keep it going?
Yeah, I'm a little bit less gloomy, I think, than Enzio, but definitely less gloomy than the general impression of what's going on. When I look at the retail sales data, for instance, if you compare each month of the year with how things were in 2019, then you actually see pretty good retail sales performance since the start of this year. When you do this, you will very nicely see the cycles during COVID, with huge depressions in April of last year during the Shanghai lockdown, later in the year last year, but you also see a pretty nice recovery. So I would say, what are the motors going forward? These motors are definitely not 6 cylinders. They are more like, 4 cylinders or so. But I do think that I absolutely take the kind of vibe from Enzio about aspects of policymaking in China. And look, what are we're talking. Yesterday we got so-called disappointingly low credit growth in China, but it is still growing at. Total social financing is still growing at 9.5% year on year. So we are pumping tons of money into the economy, and I accept that, and I agree with Enzio's impression of that. But to make the comparison with Japan, I think the only difference between China now and Japan then is that there is still a reasonable underlying pace of growth in China that is, in my view, in real terms, around between 4.5% and 5%. And so even a relatively weak China will still churn out numbers, along those lines, and therefore I'm not as somber, or at least I don't know what people expected. I think too many people had too high expectations of this recovery, because we always warned people that this was going to be a consumption and domestic services-led economy. So if you're a foreigner, for instance, you shouldn't have expected tons of spillover on commodities or whatever.
Enzio, it's a good point, isn't it? Maybe we are all being too gloomy about China, that, it's not doing as well as people were hoping, but that's because their expectations were wrong. And the economy is still growing at a reasonable clip. There's still good credit growth, as Louis points out. Does it make you more convinced, maybe, to be a bit more upbeat about China?
Well, my gloom is based not as much on that erroneous, and that's where I agree with Louis and with you, the erroneous assumption, the post-COVID recovery, that it was all going to be wonderful and the sky's the limit. Indeed, at the time we were cautioning against the sky's the limit. My concern is much more the very Marxist, the strident Marxist tone taken by the policy makers, really saying, look, the private sector, we don't really like the private sector. It will do what it will be at our bidding, otherwise it won't be. And I'm afraid that's my fundamental concern. It's less with the extravagant expectations, to quote Borston's book, but more just that it's the policy direction which Beijing has taken. And again, this Marxist route versus, in my mind, this common prosperity route, even if they say it's going to lead to common prosperity, I as an economist can't understand how that's going to work, and that's my key concern.
Louis, there is one good point here, isn't there, that despite the economy is not in free fall, it's not in collapse, but nevertheless foreign investors are bailing out of this market in droves, and they're going elsewhere, like Japan, like South Korea, like Taiwan. And is that because maybe, they are just disillusioned with the policy that's coming out of Beijing? I mean, that seems to be one of the things that's often cited here. I mean, we know that China doesn't really like shareholders. They're not interested in boosting shareholder value in the way that Japan seems to have suddenly discovered in recent months. Is that a problem, Louis?
I mean, it's a fact, right, that many people are leaving China. I think we should have a separate session on why this is happening, because I do think that the geopolitics have a huge deal to do with
Absolutely.
this. And again, we should have a good discussion on what exactly is the message that Chinese leaders are trying to give. They actually are trying to give the message that we are still open for foreign business and we like the private sector. And the current prime minister is actually a remarkably pro-private sector person.
But is it?
Unfortunately,
they don't follow that up with actions, though, do they? That's the thing. They say it, but...
Yes, they say it, and there's not a lot of action. And unfortunately, in the context of that geopolitical stuff, and that with that greater emphasis on national security, there are weird things happening to foreign companies, and so this is really not helping. And it's sad to see.
Enzio, what are your thoughts about that? The geopolitics clearly taking their toll on certainly on foreign investors, anyway.
I think Louis has raised a very important point. That absolutely you can't decry you can't sort of leave out the U.S. Machiavellian vote-getting stuff in the run-up to the elections about being anti-China. When I was doing Capitol Hill, China was always for free because nobody knows where it is. They're all communists anyway, so why even talk with them was kind of the American view, which is all a little bit closed-minded. But again, that's how they are scoring points, and any administration in America would be suicidal by siding with China. So just to embellish 1 second on that, Louis' point, just to take it one step further, is I'm sure you will probably agree that even having these backdoor talks at a second level in China isn't going to do a whole lot of good. I think that's because the Chinese don't quite trust the Americans anymore for obvious reasons.
Yeah.
What about then another issue that people are worrying about? That's all the local government debt. I think your firm, Louis, S&P Global Ratings, they estimate the debt of these local government financing vehicles at more than $6.5 trillion US. Is that another issue now that's worrying people, putting people off, or should it worry people?
Well, it's definitely a huge issue. It's a huge amount. It's also a big issue for policymakers, and that's actually one of the reasons why I don't think that we're going to see a lot of fiscal easing this time around, because there is quite a bit of focus on both not making this problem even worse in terms of flows, but also to try to hold these local governments accountable for this, which is actually much more difficult than it sounds. So it's a big issue.
What do you think, Enzio?
I think the sky is high and the emperor is very far away indeed when it comes to this local government financing mess that they've got in. And I'm afraid also that the corruption must be rampant, as indeed Beijing has said, and it wants to clamp down on it. So I think it's a bit of a, to put it in jazz terms, it's a bit of a bitch's brew on this one, and I'm afraid that's not going to go away quickly.
Okay. Let's turn our attention to the US, because obviously we've got the Fed meeting today. It's going to deliver its interest rate decision at about 2 o'clock in the morning, Hong Kong time. But the pace of inflation in the US before that has eased to its lowest level in more than 2 years, driven by a decline in energy prices. The latest CPI slowed to 4% year-on-year, down from 4.9% in April. That's the lowest level since March 2021. The core rate, though, is at 5.3%. It's still the lowest level since November 2021. Energy costs were down 11.7%. Food inflation slowed, but shelter costs are still pretty high, 8% versus 8.1% previously. Used car inflation, and we talk about this because it is actually the second biggest contributor to the inflation basket in the US. That's still high, 4.4%. Unchanged. Enzio, what do you make of this data, first of all? If you look into, the headline number, seems quite good, although when you dig into it, there are some worrying signs as well, aren't there?
Well, there are, because the stuff that the Fed really can't control, sunspots as in food prices or OPEC politics as in energy prices and U.S. lobbying efforts, those things are alongside what the Fed can do. But more importantly for me is, again, let's not lose sight of the fact that the real thing that the Fed focuses on, that 2% that it keeps on referring to as its target, is actually something different called the core personal consumption expenditures price index. And this means the prices paid by consumers for domestic purchases of goods and services, excluding food and energy. So that's what the Fed's looking at. That currently in May was running around 4.5%. That's still twice the target rate of 2%. So it's still quite alive and kicking, this the policy rate that the Fed is looking at.
Louis, what do you think when you look into this data? Do you find some things that are worrying, or are you going along with the markets, which rather cheered this number?
Yeah, I agree with Enzio rather than the markets on this. My preferred metric is to look at core inflation and then to look at how are things moving in recent months. So take a 3-month moving average of the month-on-month increase, and or just take the last month-on-month increase in that core price index, and it was 0.4%. That means an annualized rate of core inflation of still around 5%, which is 2.5 times as high as the policy rate, as Andrew mentioned. So in my view, as long as the labor market remains tight, we are not going to see inflation coming down. So to me, the Fed is still only at the beginning of this battle, and I don't agree with the market.
If you're a consumer in the US, you feel some of these things, don't you? When your shelter costs are still high and don't appear to be coming down, regardless of what headline inflation may be or what the core number may be, you as a consumer are feeling this, and it's going to change your spending habits, I presume.
You mean the shelter costs coming down?
Well, they're not they're still high, aren't they?
Right.
I mean, so you as a consumer, you are still going to rein in your spending, your discretionary spending, because you're feeling the impact of these high prices elsewhere.
That's right. But then, and then because you see your costs rising, you also will go for another wage increase to your employer. And if you're a business owner, you will try to get that additional price increase. And so this domestic battle, because I agree with Enzio, what he said in the beginning about, we often talk about oil and commodity prices. This has nothing to do with it. This is a domestic dynamics, a domestic battle on everybody wants to increase their share of the pie, and therefore inflation will remain very sticky.
Now, there was an interesting reaction in the markets. Bond yields actually went up after this data. They did come off initially, but then they reversed course and closed actually quite a bit higher. The 2-year yields are now at the highest since March. One of the reasons I heard for that is that the Wall Street Journal had a report that when the Fed makes its decision tonight and releases its dot plots, or its dot plot, I think it is, isn't it? They're going to be jacked up higher. So the Fed may well be pausing this month, but it still feels that there's more interest rates to come. What do you think the Fed needs to do, Enzio?
Well. I think it's actually more the Treasury. If I'm a little bit into your patch of being bond trader, Peter, but I would just put forth that the Treasury has to now play catch up and issue about $1 trillion worth of bills and, please correct me, bonds. I think short-term bonds, but maybe just bills. If you increase the supply, the price goes down, the yield goes up. So I think that that's also what's been happening on the the rising yield side of the equation that may have also taken some of the longer yields up with it. That I don't know. That you have to tell us. But I do think that that's something that we don't want to quite forget, the catch-up of the Treasury trying to just... The other point that I wanted to just make is that the Fed, and I'm in agreement with Mohammed Al-Aryan and yesterday's FT, is so focused on demand pull inflation, it should also be looking at cost push inflation, food, energy, people not wanting to work. That's why labor markets are quite tight, because the employers just can't get the people. So, of course, the people who do work can push up the wages and the prices, the cost of labor, obviously. So I think it's also this patent neglect of in the Fed model of the supply side of the equation that also, as Al-Aryan was saying, maybe they will start finally factoring that in to their policy framework.
He was also saying, I think, wasn't he, that the Fed's got to think about changing its inflation target.
Absolutely. And that could also be the composition again, because this mouthful that I referred to before, this personal consumption expenditure, core personal consumption expenditure price index, that is again a demand side of the equation. It's not a supply side of the equation. So a lot of very fundamental thinking has to go on at the Fed, and I think that many people kind of like what they've been dealing with for the past 50 or so years, some of these policymakers, and maybe that's also this policy intransigence is just holding up the more effective policy cognizance.
Do you think, Louis, the central banks in general are winning their battle? Are they getting inflation under control? It's certainly coming off the highs that we saw earlier in the year and last year, isn't it? But is it enough to say that they are winning the battle?
No, I don't think so. I mean, yes, headline inflation is going down, but that's because oil prices are down and commodity prices. It's fascinating for an economist to hear all these debates about, different ways of thinking about inflation. I think the average central banker is a bit old-fashioned, and they focus a lot on, wage cost increases, how a strong labor market is going to continue to put pressure, and they focus a lot on this core inflation, just like we do. So I'm not surprised to hear that there is a rumor that they're going to increase their dot plot forecasts again, because on core prices on a sequential basis still look very problematic.
Where does the Bank of Japan fit in? We mustn't forget their meeting as well this week, aren't we? And we're expecting, I think, a no-change decision from new Governor Ueda there as well. But what's your assessment of where they are?
Yeah, that's a nice one, because they are kind of facing a very different challenge. The Bank of Japan is very reluctant to increase its interest rates because they don't want to do it prematurely. They definitely see inflation rising, and there are all kinds of signs that actually this is for the first time in decades. There are things happening that we haven't seen for a long time, with firms offering higher wages and these types of things. So there is something going on, but the Bank of Japan continues to be very reluctant, because the last thing that they want to do is to increase their interest rate and then see inflation dipping again to zero and even activity weakening, because that will be a disaster for the Treasury with Japan's high debt.
Enzio, final word to you. What do you think about the Bank of Japan?
Yeah, I fully agree with Louis that they're just being quite realistic, and it's quite good that Ueda, despite being an academic, has come in and just said that he doesn't want to raise the rates. I mean, why raise them when you're just getting a little bit of life into the economy, some recovery in profits, some recovery in wages. Let's not forget that inflation is a form of a tax, but as long as people can assume that they will get stronger wages coming forward, they will be more inclined to spend. It's not the stagnant pool that we've seen, and I'm afraid where China may be headed. Just loop back to that one where we started this whole discussion this morning.
Okay, well, thank you both very much. Great to hear your thoughts there. You heard founder of Financial Shield, Enzio von Pfeil, and Louis Kuijs, who is the chief Asia economist at S&P Global Ratings.
Peter Lewis's Money Talk.
I'm joined now by Nick Smith, who is Japan strategist at CLSA in Tokyo. Morning, Nick.
Morning to you.
So the Bank of Japan meeting today and tomorrow, expected to remain on hold after Governor Ueda indicated that his ultra-easy monetary policy is going to remain in place until wage gains and inflation are stable and sustainable. Are there any signs yet that wage gains and inflation is stable and sustainable?
Well, I think what the BOJ insists on missing is that inflation Japan is really related to wage gains, which is a simple demographic issue. You just can't print more people. And so the labour market is incredibly tight. The working age population shrinking at 500,000 a year, accelerating to 750,000 a year by the end of the decade. The unions report 3.7% wage increases they've won. Keidanren, the big business lobby, reports 3.9%. And I think that the BOJ doesn't seem to want to listen to this. But I think my experience of 35 years in Japan is inflation is always and everywhere a wage phenomenon. We haven't had inflation before because you print money, drive up prices when wages aren't rising. Or, of course, all you're going to do is crush consumption, which is irresponsible.
So is the Bank of Japan, is the reason why they're doing this, or maybe one of the reasons why they're doing this, is that they're haunted by the fact that before, I think on a couple of occasions, didn't they started raising rates, and it all turned out to be too soon. Inflation didn't pick up at all. The economy sank back into deflation. Is that part of why they're doing this, that history is sort of haunting them a little bit?
To be fair, the history that should be haunting them is the history of the 1930s, where they spent heavily to get out of the Depression, with the BOJ printing the money, and inflation accelerated quickly to over 10% within just a few years, and of course, ultimately that financed their entry into to war and desperate straits. So they know that since 2009, Japanese government debt has increased by around a half. And at some stage, you've got to have the guts to say, enough is enough, we're not printing any more for you. Now, a skeptic would say, maybe the reason that the BOJ is continuing to print is the government wants cheap money because it's going to spend on increased defence spending and really interesting plan to try and almost pay people to have children, and it doesn't want to have to raise taxes to fund that.
Okay, well, look, let me turn our attention to the markets, because Japan's Nikkei 225 now back to July 1990 levels, above 33,000. People getting very excited about that. So there is a flip side to that, of course, isn't there? Which is that if we're back to where we were in 1990, it's a rather pitiful performance since then, I suppose. But at least it is the market in focus at the moment.
The market is definitely in focus at the moment. There are a lot of people trying to find reasons why they shouldn't look at it because they spent decades not looking at it and really don't want to do the homework. But you look back on the 1990s and say, gosh, I don't know how we managed to flog Japanese stocks there, because in a good year, the profits were lousy. In a bad year, the corporate Japan was losing money. So you think of Japan in terms of price to 10-year average earnings in a sort of Graham and Dodd way, and you go, the valuations then were absolutely eye-popping. But now we're in a situation where we've gone from extreme bubble to anti-bubble, and Japan is very, very cheap. And people want to say, the Economist, for example, was saying, yes, but the GDP growth rate is still not very good. And you look back on studies that show, I think it's Professor Marsh et al. At London Business School, showing correlation between economic growth and market performance over 100 years of data for 20 countries is slightly negative. But, you know, you wouldn't say, well, I'm not buying Nestle because I don't like the Swiss economy. And I'm not sure that the same argument doesn't apply to Japan.
But even if profitability is not so good, it can certainly improve, can't it, from here? And that's presumably what's also driving the markets.
Well, I think that's the case. I mean, certainly, I've had the questions: aren't things so good that they can't get any better? And I say, well, look at those profit margins; they're still absolutely lousy. So they absolutely have to get better. But the reason that the government's got its focus on this is because it's got its Japan's vast pension funds, with the exception of the government GPIF. They're all extremely underweight equity, which is a dreadful position to be in if you're going from deflation into inflation. So they need to get out of bonds into equity, and the whole thing has to work. So companies have to produce economic returns, and they have to share those returns with their investors, which is what corporate governance reform is all about.
What is also interesting is that foreign investors who are very disappointed in the Chinese markets at the moment and have really been bailing out in their droves are now talking about having an Asia ex-China product. Just like back in the 1990s, we started to see Asia ex-Japan. People are now calling for Asia ex-China, which I presume is, first of all, it's a significant shift, isn't it, in terms of performance expectations, but also, presumably, this is going to benefit Japan as well.
Well, I think it is. I mean, certainly Japan is already benefiting from a certain amount of friendshoring. TSMC building a plant down in Kyushu, Samsung spending a bit there, but there's certainly the feeling that investment in Japan would benefit from this whole friendshoring issue. So, yes, I think people are looking at Japan in a whole new way, and the question that doesn't get voiced out loud is how much of the recovery in the Japanese market is a not China trade.
And of course, the other thing is that this the Tokyo Stock Exchange's sort of name and shame campaign. Maybe you could explain for our listeners a little bit more about that, who may not be familiar with what the TSE has actually been doing and why that's been so significant.
Yeah, it's been obviously Japan is a market where broadly half of companies trade below book, and the incoming CEO of the stock exchange, Yamada-san, has come up with a plan that says companies that are trading below book must produce a improvement plan for how they should get back above book. And to be honest, a lot of investors have just said trading below book, lots of cash, will press them for share buybacks. So almost immediately after the announcement, in under two weeks after it, Citizen did a 26% share buyback and said in its announcement that the JPX, the stock exchange move, was the trigger for that, and a lot of others have said so since. So Japan is, of course, awash with cash, and there is a lot of excitement about what can happen to dividends and buybacks. Now, obviously, CEO Yamaji has been stressing, look, we're looking for something that's sustainable, not a one-off. But people have said, yeah, but which is the next Citizen watch, which has been quite amusing to watch.
I presume then this is almost causing some panic amongst companies and their boards, because the threat is what? That they get delisted if they don't meet these targets.
No, I think the CEO has repeatedly said, that there's not a suggesting that you'll get delisted. I mean, this whole thing is about name and shame. And my first gut feeling was it's only comply or explain. There's no legal force behind it. And then I was quickly warned, no. The name and shame has huge effect in Japan, as in many other Asian nations. So it's had an effect without the threat of stick.
But what is happening, isn't there? There's more activist shareholders now in Japan, and they're ousting or getting close to ousting some pretty high-profile chairmen and CEOs from their companies.
Well, yes. I mean, I think the one that caught everyone's eye was Canon, the electronics company, where Mitarai, the CEO there, his support went over a period of 2 years from 90% down to 50.6%. Now, if he'd got one share less than 50%, he would have been out. A lot of people have tried to say, this is because he doesn't have enough women on his boards. No, it's not. It's because operating margins and ROE halved on his watch, and they used to have 1.1 trillion yen worth of cash pile, and they spent that on share buybacks, and now that's gone. They go, okay, now what are you going to do?
So how sustainable is this rally? Are you optimistic that this can continue? And could it even maybe get back to all-time highs? I mean, in another 5,000 points, it's, we'll be back at new all-time highs for the Nikkei.
It would be really nice to get past the all-time highs, just as a sentiment indicator that with Japan's put that behind it. But I think that Japan's got a lot going for it. I mean, it's benefiting from the least dirty shirt syndrome this year in that that it's reopening late, and that's allowing it to grow when others are running out of puff from their own reopening. So still consumption is recovering, tourist arrivals are picking up, and there's a feeling that cushions it through through any global slowdown, and then Japan's a geared play on global recovery. So I think that there is more to it in terms of, well, it's certainly not expensive at the moment, especially when you do the required calculation of comparing its valuations with the interest rate, which is so very much lower than elsewhere by sort of 300 basis points or so.
Well, fascinating stuff. We're following this closely because it's suddenly Japan's become an exciting go-go market. Thanks very much, Nick, for that. Always a pleasure to talk to you. That's Nick Smith, who is Japan strategist at CLSA in Tokyo. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. I'll be back tomorrow when I'll be joined on the show by Andrew Ferris, the CEO of Economist Advisory, and James Wong, Chief Executive Officer at Cathasia Securities. With a view from Taiwan is Ross Feingold, Business Development Director at Safeco Group. Have a great day.
Money Talk